5%. The bank expected to announce its decision any minute from now, and we'll go straight to that. I am, of course, joined in studio as well by Maura Ferguson from PwC, as well as Lumkile Mondi there from Wits Business School of Business and Economics. Now, we will cross straight through there as the governor and the deputy governors begin to speak.
Good afternoon. Since November 2018, international developments have been the major contributor to an improved inflation outlook. Significant declines in international oil prices and a less depreciated exchange rate have been key drivers of this improved outlook. Domestic petrol prices decreased by a cumulative 3.07 rand per litre in December and January. Lower food price inflation also contributed to lower consumer price inflation. The economy's recovery from the technical recession in the first half of 2018 is welcomed, but it remains modest, with growth constrained by sustained demand as a result of weaker levels of consumer and business confidence. The year-on-year inflation rate, as measured by the Consumer Price Index, for all urban areas was 5.2% in November. Goods price inflation was 5.3%, while services price inflation was unchanged at 5.1%. The bank's measure of core inflation, which excludes food, fuel, and electricity, was 4.4% in November, compared to 4.2% in October. Producer price inflation for final manufactured goods slowed marginally to 6.8% in November from 6.9% in October. The near-term inflation forecast, generated by the SABC quarterly projection model, the QPM, has improved significantly since the previous MPC. Headline inflation is now expected to average 4.6% in 2018 and 4.8% in 2019, before increasing to 5.3% in 2020 and moderating to 4.8% in 2021. Headline price inflation is now expected to peak at around 5.6% in the first quarter of 2020. Core inflation is expected to remain unchanged at 4.3% in 2018 and forecast to remain 5.0% in 2019, 5.1% in 2020, and 4.8% in 2021. These inflation projections are based on an interest rate path generated by the QPM. Following a significant decline in oil prices since November, the assumptions for Brent crude oil in the QPM were revised down by around $10 per barrel, from $73 to $62 for 2019 and $65 for 2020 and 2021. Food price inflation is expected to have bottomed out in the fourth quarter of 2018 and to rise to 4.6% in 2021. Average inflation expectations for both 2019 and 2020, as reflected in the survey conducted by the Bureau for Economic Research in the fourth quarter of 2018, declined from 5.6% to 5.4%. Average 5-year expectations also came down from 5.5% in the previous survey to 5.3%. The inflation expectations of market analysts in the January 2019 Reuters Econometer survey are also lower at 5.2% in 2019 and remained unchanged at 5.3% for 2020. Expectations implicit in the break-even inflation rates remain sensitive to exchange rate movements. While 5-year break-even rates remain within the inflation target range, the longer-term break-even rates remain above 6%. Global growth is expected to remain broadly favorable over the near term, but to moderate over the medium term while risks are tilted to the downside. The negative effects of tariff increases are becoming more visible in economic data, and uncertainty arising from trade tensions remains. Other risks include geopolitical developments and excessive financial market volatility. Recent communication from major central banks suggests a slower pace of monetary policy normalization in advanced economies. In December, the US Fed signaled a more gradual pace of rate hikes. Although the European Central Bank ended its asset purchase program in December, it has indicated that monetary policy would remain largely accommodative. Since the November MPC, the rand has appreciated by 1.4% against the US dollar, by 1.5% against the euro, and by 0.5% on a trade-weighted basis. The implied starting point for the rand is 14 rands 30 against the US dollar, compared with 14 rands 50 at the time of the previous meeting. At these levels, the QPM assesses the rand to be less undervalued. Emerging market currencies, including the rand, have recently benefited from a weaker US dollar and indications of continued accommodative monetary policy in advanced economies, but they remain vulnerable to changes in investor sentiment. The rand also remains sensitive to domestic growth prospects, political developments, and policy settings. The domestic growth outlook remains sluggish. Although GDP increased by 2.2% in the third quarter of 2018, private sector fixed investments remains weak, and production in key sectors is volatile. The SAB now expects growth in 2018 to have averaged 0.7%. The growth forecast for 2019 is 1.7%. It's unchanged at 2% for 2020 and increases to 2.2% in 2021. At these growth rates, the negative output gap is expected to close in the first quarter of 2021. The ABSA Purchasing Managers Index reached 50.7 index points in December, driven by improved expectations about new sales orders and business activity. However, the employment sub-index receded to its lowest levels since 2014. Although the SAB's composite leading business cycle indicator increased somewhat in October, it has been trending lower since early 2018. The RMB BER Business Confidence Index also remains significantly below the neutral level of 50 index points, broadly aligned with weakness in gross fixed capital formation. Sustained growth in fixed capital formation is needed to raise potential growth and to make inroads into unemployment. Household consumption expenditure remains constrained by weak employment growth. Over the forecast period, consumption expenditure growth is expected to remain around 2% on the back of moderate increases in real wages and household disposable income. The MPC assesses the risks to the growth forecast to be on the downside. Weak business and consumer confidence continue to weigh on fixed capital formation. This could be exacerbated by the possibility of protracted electricity supply constraints. Prudent macroeconomic policies are essential to ensuring that growth is sustainable and the economy is more resilient to shocks. Furthermore, the committee remains of the view that current challenges facing the economy are primarily structural in nature. The implementation of credible structural policy initiatives that make a marked impact on potential output and employment and lower the cost structure of the economy should be prioritized. The MPC has taken note of the improved inflation outlook, especially in the near term. Over the forecast period, inflation is expected to remain within the inflation target range, averaging 5.3% in 2020 and 4.8% in 2021. The overall risks to the inflation outlook are assessed to be moderately on the upside. The risks include administered prices such as electricity and water tariffs, rising domestic food prices in the outer years, changing investor sentiment towards emerging markets, moderation in global growth, and volatile international oil prices. Against this backdrop, the MPC unanimously decided to keep the repurchase rate unchanged at 6.75%. The committee continues to assess the stance of monetary policy to be broadly accommodative. Monetary policy actions will continue to focus on anchoring expectations closer to the midpoint of the inflation target in the interest of balanced and sustainable growth. The approach of the MPC is to look through the first round effects and focus on the possible second round effects of supply side shocks. As previously indicated, any future adjustments will be data dependent. The implied path of policy rates generated by the quarterly projection model is for one hike of 25 basis points, reaching 7.0% by the end of 2021. The forecasted endogenous interest rate path is built into our growth and inflation outlook. As emphasized previously, the implied path remains a broad policy guide which can and does change in either direction between meetings in response to new developments and changing risks. So at this stage, let me take this opportunity to turn over to you and check if you have got any questions. And as usual, please identify yourself and the media house that you represent, and we shall deal with your questions. Sir, in the front.
My name is Kabelo Khumalo from Business Report newspaper. Governor, for all intent and purposes, the mandate of the Reserve Bank will be on the ballot box this year, coming out from the election, ANC's election manifesto. Just recently, as last year, we know that the Reserve Bank of the Central Bank of New Zealand agreed with the government to introduce an employment mandate into monetary policy, while keeping price stability as the main focus of the policy. So my question is that, is there room in the South African context for both fiscal and monetary policy to promote job creation? And I would like a comment on the following. Some scholars say that when a central bank tries to stimulate the economy to bring down unemployment, that will see that inflation might push up above the inflation target of the bank's mandate. So I just wanted to hear your thoughts on that. Thank you.
Alex.
Alex Winning from Reuters News Agency. My question is on a similar topic. Would the Reserve Bank defend with the same vigour that it defended attempts to change its mandate in the past, any attempts to specifically include employment creation and boosting economic growth in the wording of its mandate in explicit terms? And do you think that the comments in the ANC manifesto imply a change to the Reserve Bank's mandate? Thank you.
Yes, ma'am.
Governor, it's Pranesha Naidu from Bloomberg News. There were calls by members...
You spoke so softly, I couldn't hear your name.
Pranesha.
Pranesha.
Yes. Governor, there were calls by members of the ruling party to closely align fiscal and monetary policy. What's your take on that?
Amukela.
Afternoon, Governor. Amukela Mbata from Bloomberg News. Governor, yesterday the finance minister said that he does not believe that the central bank should make any growth forecasts, that it should rather focus on its inflation targeting mandate as opposed to giving any growth forecast. Just to get your sentiments on that view.
At the back. Yeah.
Natasha from the Business Day. Governor, I'd just like to get a comment from you on whether you think it's concerning that the bank now finds itself in the middle of a proxy factional battle inside the ANC with regard to its independence. We had the president come out very strongly that the bank should be independent, and on Sunday we had the Secretary General of the ANC saying that the bank will be nationalized in the next 5 years. I'd just like your comment on that and whether it concerns the bank that it is in a tussle between factions in the governing party.
Is that it? Okay, there's nothing on the... Huh? Alex, you can ask your next...
No, it depends on your response.
It depends on my response. So there are no monetary policy questions. So should I then say, shall we discuss monetary policy questions? And once we have dealt with monetary policy, we can come to all these other niceties. Are there any monetary policy questions?
I have a question about, so as you noted, the inflation forecasts for 2019 have come down very sharply. Does that imply that there's something wrong with the model, or is that just simply because there's a very large drop in the assumption for the Brent crude price, and the rand is a bit stronger, but not that much stronger really, a percent and a bit. How come it came down so far? Thanks.
Okay. Zianda.
Andrea Masea, Morgan Stanley. Please could you share the detail on what drove the QPM implied path to drop from 4 hikes in November to 1 hike today?
Okay, there are only 2 monetary policy questions. I expected this. Now, Alex and Andrea, your questions are actually pretty much related. The big revision came as a result of the drop in the oil price, which is in itself very significant, as we spell out in the thing and in the statement. That was a big adjustment. The second big one is that food prices that we expected to turn up, actually we expect that they will only turn up 2 quarters later in the first quarter of this year. We expected them to have turned last year. And a combination of those 2, and if you add the exchange rate, even if you say it didn't appreciate by much, a combination of those 3 meant that there was a big adjustment to the inflation forecast. And in a way, that also feeds into what the QPM then projects in terms of the policy rate to close the 4 gaps in the QPM. And bear in mind that when we presented the MPC statement in November last year, the QPM didn't expect that the MPC will take that step at that time. It just said you must take the step at some stage. So it removed one of the hikes. So that is what you ended up with. Once again, let me state that we do not mechanically follow the QPM. It's just an extra member of the MPC. So we consider what the QPM tells us, and we then exercise judgment as the MPC. If we didn't have to do that, you could just imagine this thing. We just program the QPM, then you don't need the MPC, and you just follow what it does. But that is not how policy works. Is that it from monetary policy? Shall we then deal with the other? Sianda, you are very busy today.
I am, Governor. It's analysts. So I don't know if you want to take them now or...
How many are they?
2 more.
Okay, let's take those 2.
Razia Khan, Standard Chartered. Clarification, please, on the path implied in the QPM. Has this really changed from 4 more hikes by the end of 2020 in November last year to 1 more hike by the end of 2021? What was the driver?
I thought I've answered that question. I'm sure she posted it before she had what the response. Okay, next one.
Peter Montalto. Governor, can you please talk about the 2021 forecast for CPI? Why is it lower than 2020? What is driving this that far out? This is important given you are speaking about looking through the short term.
Okay, Rashad, can you answer to Peter Montaldo?
Yeah, look, we obviously have, Peter, we have a big debate about, the value of a 2021 forecast. And naturally, the further out you go, obviously you're kind of on thinner ice. But I think that what's important about 2021 is we basically want to assess, what would it take in terms of the moving variables of the quarterly projection model to get to an inflation target that is much closer to what we've been emphasizing, which is 4.5%. And I think that essentially, what that means is to get to 4.5%. A lot of these, gaps, speaking in technical language, begin to close. So you have the 25 basis points increase in 2009 to 20. You have inflation moderating. You have the exchange rate closer to equilibrium, and those are the kind of factors that get you there. But as I say, we're skating on thin ice for 2021. But in the interest of kind of transparency and giving you a better sense, we defend 219 and 220 far more than we would 221. But the exercise of trying to think about 2021 is a useful one, and that's how we really think about it.
Thank you very much, Rashad. Let's deal with these questions. Natasha, is the SAB a proxy of some factional battles? And Kabelo, the mandate of the SAB on the ballot box? No, we are not on the ballot box. That bit we know, because we are not contesting the elections. Political parties do. And political parties pronounce on their manifestos. As the SAB, we've taken the view that this year there are going to be a lot of manifestos that get announced, given the proliferation of political parties in South Africa. It is not conceivable that we will be responding to each and every one of those manifestos. So we are staying out of commenting about the manifestos. But you have asked a question that you had said that there are scholars who had posed the question. So let us deal with the scholarly aspects of your questions and leave the politics aside. Our mandate as the South African Reserve Bank is to protect the value of the currency in the interests of balanced and sustainable growth in the Republic. Underline that. Protect the value of the currency in the interests of balanced and sustainable growth. Now, so anyone who says that the SAP must focus on growth have clearly not read the Constitution. Because the Constitution says what we do is in the interest of balanced and sustainable growth. You can't have balanced and sustainable growth if you are running imbalances, and those imbalances which include having high unemployment. But understand the wording of the Constitution. It doesn't say that the SAP must do this. It says the SAP must protect the value of the currency in the interest of balanced and sustainable growth. That tells you that the fathers and mothers of our Constitution took the view that for you to have balanced and sustainable growth, you need price stability. We are very thankful that our forebears thought of this in this manner. And you talked about Reserve Bank of New Zealand's mandate being expanded to include employment. That was the danger that they ran. And how grateful should South Africa be that the fathers and mothers of our democracy decided that this thing must be written into the Constitution rather than being left to some act that could be changed with ease. And let I underline this other aspect. The independent central bank is one of the constitutional principles that underpinned the writing of this Constitution. When the Constitutional Court had to pronounce on the Constitution for its consistency with those constitutional principles, one of the principles that had to be tested was whether the Constitution adheres to the principle of having an independent central bank tasked with protecting price stability. If you have time, you do not have to go and read the whole judgment. It was called the certification judgment of the Constitutional Court. The paragraphs that refer to the SAP are they are not many. You literally could read it and still meet your deadline this afternoon. So let us understand this thing. So when you talk about changing the mandate of the Reserve Bank, you are then talking about changing the Constitution. So you'd have to go and change the Constitution to deal with the changing of the mandate. But understand what the Constitution says. It says the primary object of the Reserve Bank, which means that the other things that you ask the Reserve Bank to do are ancillary to the primary mandate. If they are inconsistent or in conflict with the primary mandate, they are deemed to be unconstitutional. Now, Natasha, you talked about this nationalization thing and the independence of the bank. Let's understand this and separate them. Ownership and of a reserve bank and whether the Reserve Bank is independent or not are two different things. The Bundesbank in Germany is deemed to be one of the most independent central banks in the world. It's owned by the German government. The Fed is deemed to be independent. It's got a hybrid thing where you've got the Treasury and you have got private sector participation. The Central Bank of Turkey has private shareholders, and underline that, has, is not owned by the private shareholders. The Reserve Bank is not owned by private shareholders. It has private shareholders. I've spoken extensively about this before, and we have decided as the bank that we have put all the information, all the facts, all the figures that would enable the decision makers on this subject to make the decision. And we do not think it is useful for us to continue on a public debate about these things. When the legislation that removes private shareholders from the bank goes through government and eventually through parliament, we will engage with that process. And we will engage with that process with one clear intention, that we are able to protect our mandate and that we are there to protect the independence of the South African Reserve Bank as enshrined in the Constitution and as underpinned in the constitutional principles. So, that proxy thing of yours, I am not into proxies. I will not get into that proxy thing. Prinasha, the alignment of fiscal and monetary policy, whosoever is calling for an alignment of fiscal and monetary policy, where have you been for the past 25 years, where the central bank and the treasury have been interacting with each other, because macroeconomic policy is fiscal and monetary. And that is what the interaction between the central bank and the treasury has been doing for the past 25 years. To facilitate that, we have got institutional arrangements. Because the Constitution says there shall be regular consultation between the South African Reserve Bank and the cabinet member responsible for national financial matters, called the Minister of Finance. We have got standing committees established between the Treasury and the Reserve Bank. And those standing committees, one covers macroeconomics, it's called the Macro Standing Committee. One is called the Financial Regulation Standing Committee, which deals with the regulatory issues with respect to the financial sector between the two institutions. And three is the Banking and Financial Markets Committee, which deals with the interaction between the two institutions in as far as the markets are concerned. And fourthly, the International Standing Committee, which coordinates the activities of the national.
Yep, well, as you can tell there, the governor of the South African Reserve Bank, Lesetja Kganyaga, answering those questions vehemently so, and stating categorically how they feel with regards to the mixing of fiscal and monetary policy as well. Just how significant and important it is to answer those questions, to allay fears of perhaps international investors, and also perhaps to send out a message to any policymakers out there as to where exactly they stand. We will be unpacking that decision as well. The important one, of course, the announcement that interest rates do remain unchanged, the repo rate remaining at 6.75%. We'll unpack that data and a whole lot more right after the short break. Do stay tuned to SABC News.